Lance Roberts here with 3 minutes on markets and money. Let's talk a little bit about the markets today. It's Monday, of course, and after that boomer employment report on Friday, markets are a little bit flat this morning. Dow's looking to open down about 28 points. No big deal here. Markets have gotten very extended very quickly. We talked about the market being overbought early last week, and actually the preceding week we said, hey, a little bit of risk here. Market's gone, just straight up. We're up 9% since the September lows. We're at the top of the trading range. We had low volatility. Look for a correction to occur. We talked about kind of hedging against a correction in our portfolios. That correction happened very quickly. We went from 2 standard deviations overbought to 2 standard deviations oversold in literally 2 days. And then immediately reversed on headline news from Larry Kudlow's and others that we're close to a trade deal. We're not any closer to a trade deal than we were 6 months ago, a year ago, 18 months ago. But hey, it's good news for the markets. Trading algos like the headlines, right? Trade deal close, bid up stock prices. We've completely reversed that entire correction by Friday of last week. The markets basically went nowhere last week. Big correctional change here, but we're now back up to overbought again. So it really didn't give you a lot of opportunity to make any real adjustments to your portfolio. We did see this very brief oversold condition. We did remove our hedge from our portfolios last week. We're now back up to overbought. We'll probably look to re-add the hedge to our portfolios here over the course of the next few days. We'll see what's happening with the markets. As we kind of look at the longer term outlook for this, markets, mutual funds, pension fund managers, et cetera, are all trying to get positioned for the end of the year reporting. So there's going to be an upward bias. This happens every year. It's called the Santa Claus rally. As managers are trying to get positioned for their end of the year reporting, it tends to lift asset prices. So you get this effect of December. It's a Santa Claus rally. It's all happy. If you're one of the politically correct folk, it's the very full-figured holiday guy rally. So as we get into 2020 and we get into the first couple of months of 2020, we could very well see the same type of setup that we saw in 2018, which was you get a lot of tax loss selling in going into January and February because investment managers who made a lot of money in 2019 can lock those gains in 2020 and defer taxes until 2021. There is a risk because we're very overbought on this monthly basis that we could see a correction in the markets over the course of the next couple of months. So be a little bit aware of that. Make sure you're positioned accordingly. The markets do have a tendency to want to go higher right now. But once we move into 2020, kind of all bets are off because, again, just length of the economic cycle itself, the deviation in earnings. We are having slowing earnings growth. Prices are very deviated from weaker earnings. Those could very likely play catch up, and particularly if there is disappointment ultimately on the trade deal. In other words, one not getting done. China has no incentive to do one. It's very likely we're going to have more trade turmoil in the first quarter of next year. So make sure you position your portfolios accordingly, but also do some cleanup as we head to the end of the year. This is a great time to do some tax loss harvesting as well as repositioning portfolios for going into whatever you expect into 2020. I'm your host, Lance Roberts, for 3 minutes on markets and money, and we'll see you tomorrow.